Another massive bank failure with the failure of First Republic Bank. What does this mean for the stock market? Earnings are coming in good on the stock market. What does that mean for the likely coming recession? When is it going to be time to get back into the stock market? Hang on. This is not financial nor professional advice. This video is for entertainment only. Hey everyone, I'm Stephen Fox. Welcome to my channel. First Republic Bank failed and JP Morgan bought it. And of course, JP Morgan is going to make all kinds of money on this deal. So it's another consolidation of banks. You know, this is the third big bank failure we've had this year. In fact, it's the second largest bank failure in United States history. We also had the third and fourth largest bank failures this year with Silicon Valley Bank and with Signature Bank. So we're hoping that the bank failures are over by now. But JP Morgan stock went up steeply after it was announced that they're taking over. So I don't think the Federal Reserve is worried about a systematic risk yet if these failures stop. But if they increase and multiply, that's when it will get to be a problem. But so far, with their bank term funding program and discount window, they're able to handle these situations. And they're relying on the big banks, Bank of America and JP Morgan Chase are worth about $2 trillion. Wells Fargo and Citibank are each worth about $1 trillion. And the bank's size after that fourth place come in much smaller. So I think the Federal Reserve is going to rely on these big four banks to pull the system through. And looking at the chart, it doesn't say this on the chart, but Chase has about $2 trillion or more than $2 trillion worth of deposits, which makes it the largest bank in the country. And it has a decent chart. Its price to earnings is only about 10. It has a decent earnings growth rate of about 15. And it's the biggest one in the country. It's going to be the last man to fall, so to speak. If I was going to invest in something financial, it would be the only thing I would invest in right now. I would consider Visa too. Visa is a relatively good financial investment. Chase pays a decent dividend of about 2.83%. The fact that Visa reported good earnings indicates that people are still spending money and that the economy is still in relatively good shape. Looking at the chart, Visa, the symbol is V. Its price to earnings is a little pricey. It's over 30, okay, but its earnings growth rate is 20%, which is very, very solid. And they beat expectations at their last earnings call for the most recent quarter. So I think Chase is the more conservative investment of the two, and I would probably go with that given the conditions we're faced with right now. What's helping to stave off recession is the good earnings that are coming in. 80% of companies reporting earnings so far have beat expectations. By the end of this first week in May, 80% of all stocks will have reported their earnings. So we will know what the deal is by the end of this first week in May. But already it looks like it's beating expectations 80% of the time on average. and the mega caps have been doing especially well. Microsoft had super earnings. Google did well, and Meta had surprisingly good advertising income, which is propelling the stock upward. And they're like over 240 now, when they were below 200 not that long ago. So I'm sticking with the mega caps, and I like to use the QQQ and especially the triple QQQ because it allows me to get in and out quickly depending on the day. Because I don't trust this market, I want to be able to get in and get out quickly. But the more conservative thing to do would be to trade the Qs. But even that, I think you have to watch it. Because we have to see how this bank thing turns out. We think we've had the last of the major failures. We think the Federal Reserve has things set up to handle the situation so that it doesn't become contagious. It's actually beneficial to giant banks like Chase, JP Morgan Chase, symbol JPM. So I think as I pointed out, it's a reasonable possible investment. I agree with L. Larian that the recession probably will not be as bad as many people fear.
Wall Street and The Economist, the consensus view back in the summer of 2021 on the inflation question, they said transitory, you pushed back. The point you made at the time was listen to corporations. Can you learn more still now from corporations reporting so far this quarter, reflecting on the last 3 months and looking forward, than you can from the hard data?
Yes, John, it's important to do so. And earnings have, on the whole, surprised to the upside. And there's a reason for that, which is a certain element of demand remains very strong. And that's what you should look at. It tends to be concentrated in the service sector. It tends to be concentrated among companies that have a combination of pricing power, brand, and market share. So it's difficult to extrapolate to the general economy a absolute recession based on the earnings. In fact, what the earnings tell you is that it's possible, but it's not a done deal. And I think people should continue to focus on earnings because companies are giving us a lot of information as to what's ahead.
And in a somewhat humorous situation, some Russian pranksters called Jerome Powell and pretended that they were Zelensky calling from Ukraine. And Powell talked to them, and he was very blunt and open about causing a recession.
But what we're going to find is that growth in 2022 was positive but modest. It was subdued. So, 1% around that level. In terms of this year, most forecasts call for the U.S. economy to continue to grow, but at a pretty subdued level. So growth of less than 1%, let's say. But we would tell you that a recession is almost as likely as very slow growth. So that's a fact, and I think that is partly because of us having raised rates quite a bit. But this is what it takes to get inflation down. To get inflation off of the high, we've had inflation at its highest level in 40 years. To get inflation to come down, what we need is a period of slower growth so that the economy can cool off, so the labor market can cool off, so that wages can cool off. And so that's how inflation comes down. That's the only way we know to bring inflation down. And it can be painful, but we don't know of any painless way for inflation to come down.
I did some research into what happens when the Fed does their last rate hike, okay? And I didn't want rate hikes where there was not inflation because that's not comparing apples to apples. I want to know what happens when the Fed cuts rates for the final time during inflationary times, like during the 70s and 80s. And what I found is that the market continues to go down because the Fed just holds the rate at that level, and it continues to go down for about 3 months. So if this next rate cut is the last one, which it might not be from the sounds of Powell, he might go another time. In any case, it's going to be sometime in the fall before the market stops going down. So I think we're in for a rough summer. I think we just like the traditional time where the market loves to go down, October, November, somewhere in there is probably when the market's going to reach a lower point. I don't know if it will be the lowest point, but it probably will be lower than what it is now. And so right now, I am not enthused about buying stocks. I wanted to buy super microcomputer, SMCI, but then researching that further, insiders have been selling the stock. You know, it's hard to buy a stock when the insiders are giving up on it. I think they're not giving up on it. I think they're waiting for a better time, and that's probably what I'm going to do. I'm going to be happy to collect my interest checks, which are quite sizable. In fact, I've come to consider them as stimulus checks. When this nightmare market stops going down, you know, it's not even good for the shorts. The VIX is at 15 and 16. You can't be shorting the market, at least generally. I like to do the triple inverse funds. You can't really do that. You can day trade it, but that's dangerous. So you had to sit back and collect the checks until sometime this fall in my world. And that's probably what I'm going to do. And Apple thinks they can help you do that.
Who do you trust more, big banks or big tech? It's a loaded question, but in the aftermath of some bank failures, Apple is positioning its brand as a privacy-obsessed tech leader to attract savers. The iPhone maker is now offering a high-yield savings account in the U.S. Its Apple Card users will earn a 4.15% annual yield, which it claims is more than 10 times the national average. Now, let's be clear. Apple is not a bank, and it's not holding your cash in Cupertino. Instead, the money will be held in Salt Lake City by Goldman Sachs. The FDIC will insure the cash up to its $250,000 limit. To be eligible for an account, you'll need an Apple device, which reinforces Apple's goal, tying people more closely to their iDevices, locking them into the Apple ecosystem, and giving them a reason to upgrade their phones regularly. Sure, Apple collects transaction fees off of Apple Pay, as well as its newly launched Buy Now, Pay Later service, but the fees are a fraction of what the iPhone brings in. For Apple, these services are more profitable than device sales, and revenue from services helps smooth out its earnings in between iPhone upgrade cycles. Just as importantly, the more Apple services you add to your iPhone, the more complicated it becomes to switch to an Android in a few years' time. Financial experts warn there are downsides to turning your iPhone into a bank. All your personal and financial data is tied up in one device that could be stolen or lost. Your Apple ID could be hacked. And because you need an Apple Card, the credit card it already offers with Goldman, to access the new savings account, you may be tempted to use the card more as a result. Ultimately, Apple is counting on its clout to help it win depositors from traditional financial firms, betting that you'd rather sign up for a new savings account with a brand that already holds your photos, passwords, and data in the palm of your hand.
Smashing the like button and subscribing really helps the channel out, and I appreciate it. So for now, I think it's time to sit back and take it easy and collect your interest checks. You know, we haven't had interest this high like in forever. It's been 20 years or something. So you might as well just accept what you can change and go with the flow and get ready for this fall or the beginning of next year sometime into next year, because when the market does turn, I think it's going to explode forward. And there can be surprising things that happen. One surprising thing that I think could happen is it looks like Ukraine could actually win that war. And that seemed so improbable a year ago, but it's actually a possibility. in any case, it would be such a blessing if that war would end, and that would send the market higher. So you just don't know what can happen, either on the negative, but you don't want to discount the positive side either. Thanks for watching.